Dominick Tavella is with us, founder, president, Diversified Private Wealth Advisors. We just talked about some hedges, hedging your portfolio. But how can you get started setting yourself up for a long-term portfolio? Sometimes people don't even think about it. I mean, you got to start with a plan. I know that.
Well, that's probably the smartest thing to do is to start right there, Nicole. Often clients come in and they're looking at their assets, they're looking at their portfolios, and they're trying to figure out just how much risk they want to take on. But you have to look at what is the purpose of that portfolio. Is this a retirement portfolio that we're going to use 10 and 20 and 30 years down the road? Or is it a fund you're creating because you're going to buy a house in the next 3, 6, 12 months? So the risk profile of those two accounts are going to be completely different. You can afford more risk, more volatility in a longer term investment as opposed to a shorter term one. So define the goal and how long down the road is this money going to be used. That'll start to mark where you can create this portfolio.
When should you stop being risky? And what does stop being risky mean in the asset allocation of the diversification of this portfolio?
Yeah, in my world, because we don't trade in speculative assets, so risky for us is always volatility. Markets go up, markets go down. If you can stand more volatility, then your return, what your annual return is going to be over the long run, should be higher. But you have to be able to live with the ups and downs. I just recently looked at the SPY ETF, the S&P 500, and I looked at the last 15 years. That has earned investors over 9% a year. But if you got out of that investment in March or April of this year, you didn't capture not only the upside this year, but you actually sold at a 35, 40% loss. So with this volatility and your ability to stand the ups and downs really is going to define what your long-term investment is going to look like.
Right, and just how risky you are and watching that volatility. And how do you keep the costs down? I know getting in and out is not a good way to do that. How do you keep the costs relatively low?
So let me start with you in and out. That's usually a bad strategy because you're allowing your emotions to take over. And one crazy stat, I think I've mentioned it in the past, in March, we had 35% of investors over the age of 65 leave the equity markets completely. So they literally sold out at the bottom. Many have not returned this year. Now, in terms of cost, today we have just an amazing number of ETFs and no-load mutual funds where you're talking about fractions of less than 1%. So you have to keep those costs as low as possible because every percent, every dollar eats away at your profit. And over the short run, it may not seem like a significant number, but over the long run, eating away 1, 2, 3% a year in some of these products can just decimate your total return. So you want to keep very low cost, high quality investments in your portfolio, and you want to be patient with the volatility. No one remembers what happened 10, 20 years ago. They remember that if you kept your investment intact, patience, lived through the volatility, you had an excellent return.
All right, we'll leave it there. Dominick Tavella, thank you so much. Founder, president, Diversified Private Wealth Advisors. Dominick, thank you so much.